Good afternoon, everyone, and welcome to our third quarter capital markets webinar. We are continuing to work through our first bear market since 2020, but really, unlike that one, which was quite brief, this is much more classic and lasting, and our first real sustained drawdown that we've seen in well over a decade now. And it is creating significant challenges, both for retail investors, like many of which you all work with every single day, and financial professionals alike. My name is Jerry Guger, Head of Content Strategy at Manning & Napier, focused on bringing you the unique views and perspectives of our firm. And to tackle these difficult questions, I'm joined here today by Jake Simoniak, Senior Analyst of the Global Strategies Group at Manning & Napier. Our Global Strategies team is responsible for all things macroeconomics and financial markets from a top-down, high-level view, both at home and especially abroad. Jake has been with Manning & Napier for a decade, with his wide-ranging responsibilities assessing risk and opportunity across the board. We believe his expertise would be a great fit for dissecting the challenges we're facing today. Jake, welcome.
Yeah, thanks for having me. Happy to be here.
For those unaware, we do this update each quarter, and each quarter we welcome a number of new attendees to us in our way of viewing the world. So as a brief introduction, Manning & Napier is an investment manager headquartered in Rochester, New York, managing just under $20 billion in portfolios from multi-asset to all equity, all fixed income, and as well as in some select specialized strategies. Our traditional, fundamentally driven bottom-up portfolios date back nearly 50 years, supported by disciplined processes, strategies, and risk management frameworks, many of which you'll hear about today. All right, so with that, our agenda is as follows. First, we're going to provide our update to our outlook as we usually do heading into the home stretch of 2022. We will then briefly preview performance for the quarter and year to date. Happy to field any questions if you have them. And afterwards, we'll provide some color on a variety of key questions that are unique to Jake's particular areas of expertise, especially those that we know many of you are fielding each and every day. Lastly, we'll leave some time at the end open for Q&A with us. And I would like to remind everybody that, as always, we will not be walking through our views on each and every sector or asset class or country or currency, many of which I know that you guys do cover every single day. But instead, we're looking to share our perspective on what we see driving markets and provide some insights along the way. All right. So with that, where to begin, Jake? But with the economic cycle, the Fed, and inflation.
Yeah, I mean, I think you said it right there, right? I think topic number 1, 2, and 3 are inflation, the Fed's response, and what it means for markets. So you kind of think about, I guess, where we were, two plus years ago, starting to see inflationary pressures, and all we heard was how everything was going to be transitory. Supply side issues were, causing inflation to move higher, but as COVID kind of faded to the background and those unwinded, we'd be in a position where inflation was no longer an issue. Fast forward to where we are now, you've seen an inflation print in the US over 9%. The Fed has taken rates from, essentially zero to over 300 basis points. And it looks like we're in a situation where that's going to continue to be the case. And the Fed we've clearly transitioned from, the Fed, quote unquote, having our back to the Fed being an inflation fighting machine, and kind of looking at the drivers of inflation, kind of what's going on under the hood. It's fair to wonder when that's going to change. Now, we have seen some positive developments where durable goods inflation, for instance, has rolled over pretty aggressively. The problem is there's parts of inflation that are significantly stickier, and those not only haven't rolled, but continue to move higher. And that puts us in a position that's much different than we've been in the recent past.
I love the way you just put that. That was the entire outlook in effectively 60 seconds right there. But there's so much to unpack that you just got into. I loved your comment about the Fed not having our back per se. I do want to take a step back, explain the visual that we've got. This is new for everybody this quarter. This analysis goes back and looks at the most recent 5 drawdowns and says, okay, at the time of the first rate hike, where was the economy? And yeah, the first rate hike did happen maybe a few months ago now at this point, but it's an incredible illustration of an economy that's at extremes, with inflation metrics that were as high as we've seen over the past 5 economic cycles, unemployment as low as we've seen, wage growth as hot as we've seen.
Yeah.
It really is. It's a remarkably late cycle economy.
I think the last part of what you said is maybe the most important right now. Like when you think about where that sticky inflation is coming from, a significant amount of it is caused, at least in part, by the labor market. And we're going to need to get to the point where we see slack created in the labor market before we can start thinking more seriously about the Fed easing off. The problem is we're just not seeing that right now. Now, for a couple months, we did see the data starting to indicate that maybe it was getting a little bit softer, but even that in the last couple months is reversed. And I think that's kind of driven a good bit of the sell-off that we've seen kind of since the rally from June, I believe, into to August. You started to get stronger labor market data. And that just says that the Fed has space to keep fighting inflation. And that means more hikes.
Yeah, that they're going to continue to prioritize the one side of their mandate over the other as long as U3 and everything else stays low.
Yeah, I mean, the Fed can't do much to fix supply side issues, right? All they can do is try and affect it via demand. And the way that they do that is slow the economy via hiking rates.
Yeah,
that is firmly where we are right now.
No question about it. I want to go into something you had said a minute ago when you were giving your introductory remarks, and that on unpacking the underlying attributes of inflation. Can you talk to that with a little more depth?
Yeah, I think maybe the most important thing to focus on this chart is the shelter bar. So shelter CPI accounts for a very large part of the CPI basket. And until that number starts to roll, it's going to be really difficult to bring core services inflation lower. So I think the best thing to look at with regard to that is probably home prices. It's pretty cut and dry, pretty clean. And it tends to act with, certainly with a lag, typically 12 to 18 months, at least on the way up. And that's what we saw this last cycle. Now, one of the things we've seen with the Fed hiking is that mortgage rates have gone, significantly higher than they were just a few months ago. You're looking at a 30-year mortgage rate now that I believe is over 6.25 versus, darn near 3 a few months ago. So, we've started to see that feed into the housing market. We're seeing signs of pain in the housing market. We've actually seen home prices roll. So, longer term, that is a positive, but it does mean that there's more work to do. And despite the fact that home prices have just started to roll, we shouldn't take that as any sort of win on the shelter CPI side anytime soon.
Yeah, shelter is something that you're keeping a close eye on. I do want to follow up with a question that we tend to get a lot. I'm curious to know what your answer would be. How would you compare the inflation that we're seeing now? And I ought to take a second just to clarify with the visual. This isn't year over year inflation that you see in many of the headlines. We took a different cut at it. And we said, hey, let's look at all of the inflation that we've seen since February 29th or the end of February data at the start of the pandemic, and all the spending, all the monetary and fiscal stimulus, and what that has caused since then. So that's a cumulative figure. Anyway, the question I do want to ask you, though, is we hear this a lot. How is today's inflationary environment different from the 70s?
Yeah, I think there's a lot of ways to attack that question. I think I'm probably going to come at it from a bit of a more positive angle and say that one of the things you got in the 1970s that thankfully we have not seen now is inflation expectations becoming unanchored. So however you looked at it back then, forward-looking expectations of inflation came significantly off of the lows and the norms that they were at in the 70s, which made the Fed's job much, much harder than it would have been otherwise. If you think about that, if you think that prices are going to go up, you're going to demand more, you're going to demand higher wages, your boss is going to have to pay you more potentially, and it quickly becomes kind of a self-reinforcing cycle. Thankfully, this time, it looks like, at least for now, to date, we have avoided that sort of scenario. Even when you look at inflation break-evens, those have come off their highs just in the last couple of weeks and months. So fortunately on that front, I don't think the setup is the same now as it was back then, which is certainly a positive.
But there are some concerns around the stickiness and the potential. I think you had said durable goods versus.
Yeah, so durable goods has rolled, which makes sense, right? You think about kind of the way that demand patterns changed around COVID, significant demand for goods versus services, for certain types of electronics. but you're not, if you had to buy a laptop in 2021, or 2020, 2021, you don't need a new laptop now. If you had to buy a good set of headphones to work from home, to take meetings, you don't have to do that again now. So that's kind of worked through, and supply chains have eased. You don't have the port congestion you had back in 2020, 2021. The problem is with the reopening now, you're seeing demand kind of shift to the service side. I think we've all kind of seen the now hiring, the almost the still hiring side.
Travel.
Yep, travel. And again, you get back to wages and you get back to shelter CPI, and that's driving that core services number higher.
In the wages side, I guess I would wonder if wage growth stays hot, if services inflation stays hot, what does that mean for the Fed's ability to play the Fed put if we go into a downturn?
Yeah, I mean, you think about the last decade plus, and the Fed put has certainly been a thing. The Fed has, as I said earlier, the Fed has had our back.
Yeah.
Do I think that is still the case now? I do. I think the fundamental difference is that the floor is significantly lower, the bar is significantly higher, depending on how you want to look at it, for the Fed to get involved. And you look at financial conditions, you look at fixed income markets, you look at the pullback we've seen in the equity market. While it's been painful, and this isn't to diminish what we've seen, because it certainly has been painful, it has not been fun. We're just not there. You're not seeing the type of response in financial markets. You're not seeing things break the way you'd need to see them break for the Fed for the Fed to step in.
Yeah, and it feels as if, at least from an outsider's perspective, they almost want to break something.
It does feel that way, and I mean, you could argue that they almost have to, right?
Yeah.
You don't want to say they have to, but it feels that way at times. Like they need to create slack, and the Fed only has so many tools to do that.
Yeah, blunt instruments. That's raising interest rates and monetary policy. All right, so that is definitely creating a bit of a sense of, I don't want to say outright pessimism, but certainly concern. We identified that last quarter with this particular visual. We've updated it again. It's not just in investor sentiment, where we see where markets are, and it's clearly rolled over to a large extent, but also working its way into sentiment surveys. And in this case, this is business conditions from the Conference Board Business Owner Survey, a really sharp turn down. It's something that has historically been a concerning indicator.
Yeah, I mean, a lot of the sentiment data, a lot of the Fed survey data, the ISM new orders data just the other day, a lot of that does not point to a particularly rosy scenario moving forward. And the thing that's interesting about the survey data is at some point it tends to become self-reinforcing. So even if the survey data tends to get better, that is going to affect decision making in real time. And we tend to see that feed into kind of economic activity as we move into that period, if that makes sense, right? And that, I guess, looking at the bottom chart, we're looking at investor sentiment regarding equities. And, on one hand, it certainly looks negative. On the other hand, you're not at the extremes that we've seen in the past, at past bottoms, right? And even then, sentiment can stay poor for a very, very long time. So while it's a decent indicator to look at, it's certainly something that we track. It's historically not a great indicator for kind of timing bottoms in the market. And frankly, that's not something we attempt to do anyway, right?
Yeah.
It's important to understand kind of where sentiment is. It's important for decision making, but it's one tool, it's one data point that we have available to us.
I know I was, in my comments a second ago, pretty focused on what we've seen in the equity market and some of the obvious downturn there. Is there anything from a sentiment or kind of, that standpoint elsewhere?
Yeah, I mean, I think the one thing that really stands out to me is, again, when you look at past bottoms in markets, PE on the S&P tends to be down around 11 or 12, and we're up around 16, 17 right now. Volatility in the equity markets, the VIX, tends to spike to over 40, and we're down under 30 right now. Well, we're around 30 right now. That's in stark contrast to fixed income, where volatility is much higher, right? It's in stark contrast to FX, where volatility is much higher. I mean, shoot, you think of some of the FX moves that you've seen in developed market currencies this year. those are the types of moves you expect to see in times of financial stress in emerging markets, not in the euro, not in the pound, not in the yen. So it's certainly been interesting. It's certainly been exciting. It's not been exciting in the same way that kind of the latter half of 2020 and 2021 were, but it's the situation we're in now.
Yeah, but volatility can sometimes breed opportunity. I know that's something we want to get to in a little bit.
Yep.
Let's turn our attention we covered the economic outlook and viewpoints there. We've talked about how we know sentiment can drive the bus in the short run. This is kind of what we're seeing at the moment. But diving into financial markets specifically and starting, mention fixed income, let's go right there. Can you speak a little bit? And here we wanted to start with some of the rise we've seen in interest rates, visualizing it a little bit differently here, showing the yield curve, classic 10s minus 2s going back 4 decades plus. Jake, what's the yield curve telling us?
Yeah, I think the big takeaway here kind of echoes some of what we've hinted at so far in this call. And that's simply that when the yield curve gets to the point where it's as inverted as it is now, it doesn't mean that you have to have a recession, but it certainly means that the probability of getting one is elevated. And that's really all we can do. We can think in probabilities and we can weigh potential outcomes and, allocate capital and make our investments accordingly. And when you look at what the yield curve is telling you right now, it's difficult not to draw the conclusion that we're probably in for some economic stress, in the coming months and quarters.
You said coming months and quarters, and I know that's something else that we've been looking at, and I think you guys pay a good deal of attention to this, is not just coming quarters, but further ahead. Last time we presented 3 months ago, we had a visual up here on 2023 rate expectations, because that was telling us a unique story. Can you speak a little bit to kind of the longer run expectations and maybe what that's telling us?
Yeah, it's interesting right now when you look at markets. Right now, it looks like markets are pricing in a terminal Fed funds rate of about 440 basis points versus about 325 where we are now. So we're talking about another 115 basis points of hiking. What I think is interesting is that the market kind of sees us getting there by the middle of next year, but then kind of maybe pausing for a couple months and then actually starting to slowly cut rates again, kind of out of the back half of 2023 into 2024. And it's difficult to just take that data and kind of paint a picture in your head. But what it says to me is that just kind of screams of the quote unquote soft landing that I'm sure we've all read about, heard about, talked about. And the fact remains that the Fed has never fought inflation back from a level like this and not seen a recession. So again, it doesn't mean that we have to see a recession, but it's just another piece of that mosaic that tells you like the odds of us kind of heading for a tougher economic environment moving forward are certainly elevated relative to where they were just a few quarters ago.
Yes, at least some kind of deceleration in growth ahead. Another area of fixed income that continues to shed some light on forward outlook, forward trajectory is not just rates, but spreads themselves, which of course are a function of rates, but nevertheless, you mentioned soft landing. When I look at right here, we're looking at high yield option adjusted spread. So essentially yield over the relevant treasury maturity. That doesn't exactly show screaming fear to me.
No, it certainly doesn't. You're 100% right. I mean, there's some technical reasons that it looks the way it does. You've had some higher quality corporates get downgraded in the last couple quarters. So you've got kind of some higher quality, high yield, if that makes sense in there relative to what we had, maybe a few quarters or a few years ago. You've also got energy that makes up a pretty big chunk of the high yield index. And right now, despite the pullback in oil prices, energy companies are flush with cash, profitable. So that's gonna help with that sum. But at the end of the day, you're right. I look at that and I say, listen, I look back at past recessionary periods or times of economic stress, and we're just not even close.
Yeah. The risk reward is.
And that's exactly it, right? We talk about thinking in probabilities and you think, risk reward is the other side of that. It's, what are you being paid to do? And you look at that chart And it's hard not to think, given the outlook that we talked about and kind of, gone back and forth on a bit so far, it's difficult to think that the risk reward is real attractive looking at a chart like that.
Yeah, and to be clear also, we picked this for a little bit of a unique reason, that being we believe high yield as an asset class and as a strategy makes a ton of sense as part of a broad multi-asset portfolio for a lot of client types. We are closely monitoring the situation and really preparing the shopping list, because when we see this, there's some turn higher, it's starting to get more attractive, and we definitely have, thinking in terms of our broader outlook, that there's going to come a point in time, perhaps in the not too distant future, where something like this is going to look very attractive to increase allocations to within client portfolios.
Yep.
I know that that's something our managing director has recently been communicating about. I was going to mention that later, but we have a recent publication that we encourage you all to take a look at from him on the topic. So there are opportunities out there. We said volatility breeds opportunity, but worth mentioning here specifically on high yield. To put a bow on fixed income more broadly, though, this is a staple visual because it speaks to fixed income valuations more broadly. Is there anything that jumps out to you here, Jake?
Yeah, I mean, the thing that jumps out to me is that despite kind of the backup in yields that we've seen throughout the course of the year, when you take a step back and look at a chart like this kind of more holistically, the starting point for forward returns is still just not terribly attractive, right? It's a situation where I think that it's going to be a challenge for investors to generate the returns that they need to achieve their goals solely investing in bonds. Now, I don't want to confuse my saying that for the idea that there are not opportunities in the fixed income market, because that's far from the case. There absolutely are. But broadly speaking, it's still going to be a challenging environment.
Yeah, and it also is important to note, because when we get from the topic here, which is fixed income specifically at hand, we want to cover our views on the equity market, but the two don't live in a vacuum. They're not distinct and separate from each other. And when we think in terms of what do you want your equity allocation to be, what do you want your fixed income allocation to be? Hey, equities maybe don't look that attractive. How do bonds look when they're yielding 2.5%, 3%? Becomes a more difficult calculus.
No question.
All right, let's get into the equity market. And here specifically, we wanted to highlight a more broad view of equity market valuations. This is the cyclically adjusted PE, also known as the Shiller PE. It's a 10-year look back looking at price to earnings ratio valuations on the S&P, and they've gotten better, but they are by no means a screaming buy, hey, the market's, dirt cheap, buy all the shirts you can.
Yeah, and I think that's exactly the takeaway that I have when I look at that chart. We have come off incredibly frothy valuations, but we are not back to the point where the market is attractive yet. And I think the other thing that I would layer onto that too, that we don't have in here, but when you look at earnings estimates for 2023, so far we've seen estimates come in for the broad index, 2 to 3%, which is not significant. When you look at past recessionary periods, typically the downward revision in earnings is in the neighborhood of like 10 to 15% at least. So there's significantly more downside for the E portion of the PE, which would make that chart look even less attractive than it does now. Now, the flip side to that is I think that, a lot of the mega caps in the index probably make this chart look a bit less attractive than maybe the median stock is. So when you look at the drawdown in the median stock and kind of the way that multiples have compressed there relative to the broader market, I think the headline indices kind of mask a lot of the pain that you've seen in the broader market. And that's something to consider. So, I know for us, we're starting to see opportunities now that maybe we didn't see a couple quarters ago in some of these names that have sold off more aggressively, have seen their valuations come in more significantly than the headline might suggest.
It's funny you bring that up, because that's something that we used to spend a lot of time talking about, the concentration in some of the major names in these broad indices and how their weightings were getting higher and higher, in some cases even higher. Yeah, it almost comes full circle now in a situation like this if you're just taking indices for face value.
Yep.
Can you also give us a little color? You mentioned a second ago on some areas where we are doing work, for lack of a better word, or starting to think about the shopping list. Any
Yeah.
color you could add there?
Yeah. So our analysts at Manning and Napier tend to maintain what they call a fire drill list. And I think a shopping list is a good analogy. What we essentially do is we look at parts of the market, whether it's an industry, whether it's specific companies that we think are particularly attractive. We're not just focused on the stocks that we own at the moment, right? We're thinking about, okay, this is what I have now. I need to follow these stocks. But I also want to keep an eye on things that maybe I can't buy now, but if conditions improved, if valuations came in, this is something I'd be interested in. And I think it's fair to say that given the pullback we've seen, especially kind of under the hood, the fire drill lists are filling up. Analysts are getting excited about a lot of the stuff they're seeing, a lot of strong profiles that maybe we haven't had the opportunity from a valuation perspective to take a bigger bite of, that we'd be particularly interested in moving forward. Now, some of that is going to be conditions based. We're talking about being in a much later cycle environment, and there's certain industries and sectors that tend to do well early cycle. That we're not going to hold through a cycle because they don't perform well through a cycle, but early cycle they will. So potentially something like, I don't know, home builders, or companies that benefit from investment in technology hardware. And maybe the other side of that, more from a valuation standpoint, as opposed to a cyclical standpoint, although the cycle is important as well, is kind of a strong, secular bet, maybe something like automation, where those companies tend to be incredibly expensive as we move through the cycle. But given some of the price action we've seen, given the way some names have pulled back, maybe there's names in that area that are going to be of particular interest to us moving forward.
Which is a good point, because we have and continue to, in general, be of the view that the longer term outlook, not thinking in terms of quarters, but in thinking in terms of years, 5 years, 10 years, will be of a slower growth world.
Yeah, and yes, I agree with that. And I think that leads to an important point too. As painful as this can be, and as difficult as the environment has been, it's important to remember that, for a lot of the names that we like a lot, for a lot of the strong profiles that we continue to hold, the price action that we have seen has not fundamentally changed the outlook for the business or the quality of the company. So there's no doubt that the period has been particularly painful, but it gives you an opportunity to kind of dig in, build your conviction in these strong profiles that you want to hold coming out of this. There's no question that some of the best investments you'll make will be made in the depths of a bear market where things are the worst, where things feel the worst.
Yep. Yeah, absolutely. And which brings us really nicely into the final sort of wrap up slide that we'd like to share on our outlook. And that being, while you have heard us have a more cautious stance, certainly, on our economic outlook, we have some reservations on valuations in fixed income and equities at the moment. We are continuing to think in terms of long-term disciplines, long-term goals and objectives, probably the same types of things that all of you have been communicating to your clients for years and years, which is don't focus on the short term, don't trade the market, don't try to time the market. This is about time in the market. And we wanted to share this visual here. We don't have 2022 data up here because we are not yet 3 or 5 years away from that. It certainly happened fast. But looking back over the past 10 or so, I'm not even sure how many we have on here, the story is clear that investing in the market, that sticking with your disciplines, your investment policy statement, and staying the course remains a super important thing to continue to reinforce with your clients. Something that we're thinking in terms of, you just alluded to it, going through the shopping list. I think it's important to highlight that in times like these, this is when our teams and our analyst groups are looking in saying, I have wanted to buy this for a long time and I have not had the good point to do it. And now I finally am getting the right price that I'm looking for. And that can be great long-term.
Absolutely.
Yeah, it can allow you to have your next investment be, I had to do this because I love the phrase, but volatility can allow your next investment to be your next best investment. And that's kind of where we feel we are. All right. So with that, I'll close the soapbox for a minute and let's turn over to performance.
Yep.
So we wanted to make sure that we had a chance to provide some context share some market color as well. Here we've got broad equity indices, including the fixed income ag at the end. It has continued to be difficult in the third quarter, building on challenges that we had seen in the first half of the year. Large and small caps, no exception there. Growth versus value, a little bit of the reversal that we had seen with value dominating the first 6 months of the year, at least from a relative perspective. Growth kind of got a little bit back on it during the quarter, but nothing to write home about considering where the broad 9 months have been. International has continued to lag domestic, something that has really been a theme, probably not talked about enough, really, over the past 5 years plus at this point.
Plus,
And then the ag specifically, further pain in fixed income markets as well. Jump in, please.
yeah, I mean, how many people would have thought at the beginning of the year, if we would have known what inflation was going to be doing, that the best place to be would have been in cash, right? Conventional wisdom tells you that, you don't want to hold cash in an inflationary environment. And the price action we've seen in financial markets, has said otherwise. I think this is the first time in kind of the relevant history, kind of modern history of financial markets, where we have seen US fixed income markets be down 3 quarters in a row at the same time that, equity markets have been down as well. And, there's been nowhere to hide. Fortunately, we took up our cash allocation in our multi-asset class portfolios earlier in the year. But it's been a very difficult environment, to say the least.
Yeah, certainly. And these are multi-asset class strategies, or a selection of them that we would like to preview for everybody that we have the data on thus far. And we certainly have been caught up in those broader currents, Jake. To be clear, we are not satisfied with the performance year to date. No question about it, but it has certainly been a difficult environment.
Yeah, no question.
Anything you could further speak to, on the internals underlying that, either in multi-asset or maybe on the all equity side, and some of the changes that we've undertook there from a security selection standpoint?
Yeah, I mean, I think fair to say at a high level, we have gotten more defensive in our views within the portfolios kind of throughout the year. Now, I think the counter to that is kind of what we talked about earlier, in that long term, the secular view is that when we come out of this, we are still in a growth starved world where you want to own strong companies that could create their own growth and kind of control their own destiny. And unfortunately, a lot of those companies tend to fall into the quote unquote growth basket. And I say unfortunately, because as we've seen this year, as yields have risen, those tend to be what we would call a longer duration asset. And kind of the practical implication of that is that rising rates tend to force people to increase their discount rates, which means that those companies are worth less today. And what that means is that a lot of those growthier companies that we consider strong profiles have certainly had a tough go of it this year. There's no dancing around that fact. But again, I would get back to the idea that the kind of the growth trajectory in the future for these companies has not changed because of what's happened in the market this year.
Yeah, and from a security by security standpoint, and in many of these portfolios, and the ones we're showing here, they're built from a bottom-up perspective. Our teams are looking for longer term horizons. They're both thinking about the cyclical short term, which can sometimes be overwhelmed by macroeconomic moves, but also thinking in terms of the long term. Do I like the fundamental positioning of this particular business over the next 3, 5 plus years? Because that's where true value can be created.
Yeah, absolutely.
All right, so that is these are our all equity strategies, as well as a selection of some of them that we'd like to highlight as well. Diving into a few of our more popular niche strategies in addition, starting with the disciplined value portfolios. Those portfolios are obviously more indexed to value specifically, which has been caught up in the currents, albeit certainly better than growth and the impact growth has had on some of our other portfolios. But the disciplined value strategy specifically is meant to capture a quality type of value. Value can sometimes be perceived as names that are real staples versus sort of the junk value names. They all get lumped together. this particular strategy is really focused on names that have high dividends, strong free cash flow, healthy balance sheets, quality type value names, your staple type growers. That bias within the value space has incrementally aided it thus far this year, but certainly something that we think could make a lot of sense given the outlook at the moment. Also turning our attention to the Rainier team and the international small cap strategies that they manage. Sort of the opposite story there. The nature of that asset class is one where there's a big pool to fish in and a lot of growth within the space. The portfolio tends to have a bias towards growth. And that has certainly been one of, I almost think of it in terms of 3 headwinds for that strategy so far year to date. Moves in the dollar, which I know we want to get to in a minute. The growth versus value bias, which we've now been talking about for 5 minutes, as well as the strategy's bias away from areas such as energy, and that has certainly been a challenge. Would point out that that strategy celebrated its 10-year anniversary earlier this year. A apt time to celebrate that, certainly a challenging year, but a remarkably strong track record for the strategies over the 3, the 5, the 10-year period because of the nature of the asset class, because of the opportunity set and its ability to really add value. It's really unique. It's a space where having an active manager to fish for, you can really add a lot of value within client portfolios. And this is not a strategy that comes on sale often. Rainier really is never on sale. So yes, a difficult year, but the flip side, volatility creates opportunity, right? So I would encourage everybody to think in terms of what Rainier could do for portfolios as a strategic asset allocation. All right, time to turn our attention to what I always enjoy each quarter, which is taking a minute to get into some of the specific areas of your expertise. I know you spend a lot of time thinking not just in terms of the U.S. economy and U.S. financial markets, but the global economy, global financial markets, and what ties all of that together than currency and or the world's reserve currency, the dollar itself. We received this question several times in advance of this presentation. We grabbed one of them here. But any broad comments on the dollar itself and also what would cause a turnaround in the dollar?
Yeah, I'm gonna have to try to not go down the macro rabbit hole here and stay on topic. But I think to answer the question about what would cause a turnaround in the US dollar strength, it's important to think about kind of what we've seen that's caused the dollar to strengthen the way that it has. Now, I would caveat all of this by saying, maybe more so than any other market, it's difficult to know what is going to drive fixed income or FX markets, and even difficult at times to know what is driving them kind of in the moment. With that said, I think there's a number of things you could look at to potentially kind of contextualize and understand what we've seen. I mean, for one, you've seen a dramatic move in real rates in the US where they've gone from being significantly negative to significantly positive. And that certainly becomes more attractive and can pull capital in. You've also been in an environment where the Fed has been among the more hawkish central banks globally. And I think that has been definitely a tailwind for the dollar. The other thing that you see in times of stress, kind of broadly times of stress, is that safe haven assets tend to do well. And there's no question that the dollar is a safe haven asset. You think about kind of the share of global commerce that's conducted in dollars, the amount of dollar debt in the world. Even if people think that things are going to get worse, you almost end up in a prisoner's dilemma type scenario, where more of a game theory type scenario, where if you think things are going to get worse and someone else is going to need dollars, you're going to try and grab dollars before them while they're not super expensive. And that becomes self-reinforcing very quickly. Finally, geopolitics have also certainly been a tailwind to the dollar as well. So you put all that together, I think the most obvious answer is what could cause a turnaround is the Fed. So if we get a Fed pivot, it's not just going to be US equities, global equities, really, to probably perform really well. It's going to be all kind of risk on assets. And I think the dollar would weaken in an environment like this. I think there's also more one-off type events that could lead to dollar weakness. Potentially an incredibly strong fiscal stimulus in China, but I think they've shown that that's pretty unlikely. Potentially, a negotiated settlement to the war in Ukraine and Russia. But again, that seems to be going the other way right now. So I think the best and most obvious answer is the Fed, but there's certainly other things that we're keeping an eye on. And this is something we talk about, almost every day. It's going to be one of the things to keep an eye on and try and get right coming out of this.
How could you not? Here we're visualizing the US dollar index, which is the dollar's strength against a broad basket of currencies. But, you see the headlines every single day. The move against the pound has been remarkable. The euro breaking a dollar.
Yeah, what's really stood out this time has been the strength of the dollar versus other developed market currencies, right? You expect the dollar in times of stress to perform really well against, the Turkish lira or the Argentine.
Right. Yep.
But it's been the yen, it's been the euro, it's been the pound that have really stood out to us.
Yeah, it is remarkable. So you mentioned global geopolitics, and so I did want to use that as a transition point to another kind of series of questions, should I say, and we sort of lumped them together here, but we continue to be asked about China. Sometimes it's, are you investing in China, or what are you doing to avoid China? We get the gamut here. More than anything, I guess I want to just give you a minute to talk about what you see there. Yeah. I know from your lens, China is more than just an area you invest or not in. It makes a difference on the global economy.
Yeah, no question. China is the second largest economy in the world. They're the biggest consumer of commodities. So, there are a lot of asset markets that depend on what's going on in China. Now, I think what's interesting, one of the things that stands out to me when you look at China right now is that most major markets in the world are running tight monetary policy, and fiscal certainly tighter than it was in 2020 when we were at absolute extremes, but fiscal is a bit more mixed. You're starting to see, especially in Europe, looser fiscal policy, but we can kind of get to that later potentially. It stands out that China is running loose monetary policy and loose fiscal policy, which would kind of put them significantly more early cycle, especially given that they don't have the same inflationary pressures that the rest of the world does. I think the thing that's so challenging is that typically in an environment like that, you'd be thinking, okay, it makes sense to start looking at, more cyclically geared names, at commodities, at EMFX, more risk on type assets. The problem is that China, I guess there's two problems in China right now. One is that they continue to maintain their zero COVID policy. The other is that they continue to, the property market continues to be an issue. Now they've shifted from outright tightening in the property market, which is kind of why I rephrased and pivoted from what I was about to say, but we're not seeing the type of support you need to bring buyers back into the market. And until that changes, despite the fact that China looks like it's going to be earlier cycle relative to other countries, I think it's fair to expect the response you see from the Chinese economy, despite the policy efforts, is not going to be what you have seen in the past, which means it's going to be a challenging environment for, commodity dependent EMs, for cyclically geared companies that sell into China. It doesn't mean that you can't find opportunities, but this is not the same type of policy environment that we've seen in the past right now.
Can I also take a step back and explain to us exactly what we're looking at here in the visual?
Oh, absolutely. Apologies for that. So this is one of my favorite charts. I had Jerry put it in. This is the Chinese credit impulse. And this essentially looks at the flow of credit relative to the size of the Chinese economy. And basically what it tells us now is that we've reached an inflection point. Credit flowing to the economy is no longer contracting. Not only is it not contracting at a slowing pace, it's actually accelerating. The problem is you don't have the demand that you've seen in the past to kind of take this credit, really recycle it into the property sector, which is what we've seen for years and years and years, and have that be a driver of growth in China.
I would also say that is a great plug for why pre-submitted questions are so valuable, because it gives us a chance to prepare something ahead of time. I know we're going to take live Q&A in a minute, and we certainly appreciate that as well. But to have a minute to say, hey, we actually have a great visual that we track on this particular topic, and to be able to share it with all of you is why we would like to thank you for doing that. Also, I did want to say it struck me. You made a comment about how China is looking at perhaps a very different cycle in response to it than they have before. We talked about how the Fed may be a little bit more hamstrung in their response than we've seen before. The world is sort of changing and different from what it was pre-pandemic. I want to give you a minute to kind of speak to some of the changes that you're tracking.
Yeah, I think before I dig into this, I would say again, the outlook that we have right now is for a secularly challenged environment moving forward in terms of growth. So we continue to think that we are in a slow growth world, and those strong growth profile types of companies that we own are the ones that we feel good about owning right now. With that said, there are enough things happening and changing in the world that I think are forcing important conversations about what the next decade could look like. Now, it doesn't mean that we're changing our view, but it does mean that we're looking at the things happening in the world, asking questions and kind of digging into what it could mean for investments moving forward. So I think there's a few things that I would point to that are particularly interesting. Demographics are one.
Yeah.
So for a number of years, you've had pretty strong demographics, especially from places like China, Eastern Europe, where these geographies have been integrated into the global workforce, and it's helped to keep wages down and lead to strong productivity growth. That's reversing moving forward. Now, conventional wisdom would tell you that an aging demographic tends to be disinflationary, and that may well be true. But there's also a pretty strong argument for the idea that as populations age, consumption patterns change, and maybe really simply, you've got more consumers than you have producers. And we haven't necessarily been in a period where that's been the case. So it's more than fair to question conventional wisdom about what changes in demographics could mean for something like inflation. You look at something like globalization, you talk about geopolitics, and we are not in the same situation that we were in 3, 4, 5 years ago, right? You think about China's ascension to the WTO and how the world globalized like after that. What happened to global trade? What happened to supply chains becoming global as opposed to local? And that's just nothing that you hear about today, right? It's all the opposite. Geopolitical tensions have risen. We are economically, I don't want to say at war with, but there are serious issues between the two largest economies in the world now that maybe were not at the forefront the way they are now just a few years ago. We talk about supply chain reshoring, nearshoring, friendshoring, however you want to say it, reconstructing supply chains while potentially disinflationary years out because of excess capacity. Like that changes demand patterns for industrial machinery, for things like that, for commodities. That has the potential to be an inflationary pressure in the medium to longer term. Now, again, none of that means that the situation has to change because, something like debt. Debt was a problem before. That's one of the impediments that we see to stronger growth, and that's only gotten worse. Demographics, we talked about. Demographics are getting worse, and potentially that is disinflationary. So nothing we're seeing forces us to change our views yet. But again, it's the type of conversation that as an asset manager, somebody investing money, these are conversations you have to have. You have to think about how the world could be changing and what it would mean for portfolios.
Yeah, and I think a lot of the work that your team does helps steer the ponds that we then want to fish in from a bottom-up standpoint.
Yep. If I could I transition to one of the live Q&A questions?
Yeah, please.
So one of the questions spoke specifically to kind of challenged equity returns moving forward. And it's an interesting topic because it's a conversation that we've had internally a lot up in research. Are we going to be in an environment where it's challenging to generate the types of equity returns in the future that we've seen in the past? And I think we'd be in agreement with the idea that, yeah, we are going to be challenged. But what I would tell you is I think that increases the importance of having an asset manager that is having the types of conversations we just talked about. Because to me, what that means, it doesn't mean that there's not investment opportunities in the world. It means that the investment opportunity set could potentially be changing. And I think that's the important point. Even in a world where equity returns are going to be muted, it might mean looking somewhere else for returns, looking in a different sector, looking for different thematics, looking in a different part of the world. And I think that's something to keep in mind. Even if equity returns on headline indices are going to be challenged, that does not mean that there are not opportunities out there.
Well said, well said. I do want to continue this theme because I know that we had a bonus visual we wanted to share with all of you on some of these structural themes. I love your point on how it will impact portfolios specifically. Can you get to this particular concept and share why this is important enough that we wanted to make sure it was in here?
Yeah, so this looks at kind of business investment as a percent of sales. And I think the clear takeaway is that, I mean, for decades, it's essentially been falling. And especially in the last, we call it decade and a half, what we've really seen is a significant amount of financial engineering. And I guess the consequence of this chart is that we have seen a lack of investment, and I guess very simply what I would call things, whether that's industrial capacity, whether that's machinery, whether that's the ability to pull the materials out of the ground that we need to build a new electric grid or electrify the vehicle fleet. At a certain point, to achieve the types of goals that we're talking about, the policymakers are talking about, that investment has to turn. And again, if we saw that chart inflect upwards and move higher sustainably, that's impactful for investments, because that investment is someone else's revenue. And you look at that, those types of companies have been seeing less and less and less revenue over time. If that reverses, that suddenly changes the opportunity set that you'd potentially be interested in moving forwards.
Yeah, and as you had just said, it makes me think of the paradox of thrift, the concept that, hey, you went out and you saved $1, that's $1 of revenue that somebody else doesn't get. But in this case, speaking of business investment.
Yep.
All right, so I know we're getting close to the top of the hour and we have a number of questions. I'm glad you grabbed one already. So let's turn our attention to live Q&A. I know I mentioned this before. Please feel free to submit any of your questions throughout the course of the rest of the event. If we can't get to it, which I don't think we're going to be able to get to all of them, we will make sure to follow up afterwards. I'll also call attention to, while I have everybody's attention, towards some of the comments we made earlier on the fixed income market specifically. We encourage you all to take a look at our website. We have a number of insights up there, and one that we think is particularly sharp right now is a recent letter from the desk from our managing director of fixed income, speaking to what he's seen in the rate and yield environment and on high yield specifically. So we encourage you all to take a look, subscribe, and browse. All right, so with that, let's turn to some of these live Q&A questions here. Jake, first one, can you speak a little bit? So we haven't really come anywhere close to talking about this yet today. It was something we used to talk about on a quarterly basis, but this particular listener is asking about the sell-off we've seen in cryptocurrency and on the, you're laughing, in this case, on the Ethereum merge. Can you maybe explain what that is and then take a swing?
Yeah, so I don't want to go too far down the rabbit hole and get really technical with this, but the merge is essentially Ethereum, which is one of the largest blockchains, switching its consensus mechanism, which is essentially how blocks are added to the chain. It's transitioning from what we would call a proof of work mechanism, which is similar to Bitcoin, to proof of stake, which I guess at a very high level, much less energy intensive, a bit more predictable. But speaking to crypto more broadly, I think what happened, unfortunately, is, as tends to happen when things are going well, kind of narratives take hold and people lost sight of what crypto was as opposed to kind of what maybe they were being told it could be or what they think it will be later. As somebody who is, this is my view, fairly bullish crypto long term, I think it's important to keep in mind that right now, what it is a risk on asset. And what we saw is last fall, it's a retail driven market. People had to go back to work, stimulus dried up, maybe the economic environment started to get a little bit tougher. Marginal buyer, started to exit the market, and it went the way of risk assets. And it's a high beta risk on asset. It's performed similar to other risk on assets that we've seen. and performance has struggled.
Yeah, absolutely. All right, I want to keep the pace up here. This is going to turn into a little bit of a lightning round as we get close to the bottom there. We do have a live question in here that actually aligns really well with the appendix slides, which I'm required to roll through. So I'm going to grab that real quick. Here we're showing our usual performance appendix, but the question asks, can you speak to the active-passive debate as it relates to market performance today, the current downturn we're going through, and some of the results that listeners are experiencing? What I would say to that is active versus passive is a little bit different than downside protection per se. It's about finding opportunity when it presents itself. In many cases, there was a ton of opportunity out there, certainly opportunity to be had this year, as there is in every year, but there are times where there's more or less opportunity, or when that opportunity set aligns better with your disciplines that we go through. It was certainly the case that in 2020 and 2021, that alignment was tremendous. This year, certainly less so, and we want to be clear about that fact. But we still 100% believe in the merits of active management. But what we would say is active management and its ability to generate value over full market cycles. There's going to be quarters or years, certainly such as the one we're going through, of flat performance versus benchmarks or down performance versus benchmarks. But we would encourage everybody to think in terms of what the value of active management and the disciplines and processes that we've spoken about today can provide over the long term. I don't know if you have anything to add. We got a whole bunch of other questions there. I'm happy to keep rolling, but.
Yeah, no, I mean, I think the only thing I would say really quickly is that harken back to some of the conversations we had earlier, where if we think we're in an environment where the world is potentially changing and headline equity, returns are going to be subdued, I think you want to find somebody who's interested and able to pursue opportunities and opportunity sets that might not be conventional, might not be kind of conventional wisdom and where everybody else is looking.
Yeah, 100%. And certainly the case with many of the strategies that we discussed today. I'm thinking about the Rainier one in particular as almost example of that to the extreme. All right, got a question here. So we had Beth on, our managing director of capital goods, last quarter. She spent a good deal of time talking about oil prices and the energy situation. And she was asked specifically about the European energy crisis. And I know we got some positive feedback on that specifically. Jake, can you update us at all? I know you don't cover these names from a bottom-up perspective, but any top-down macro thoughts on what's unfolding in Europe and the energy crisis that they're facing there?
Yes, there's a lot I could say. I'll try and be quick and kind of think about what's coming, and again, more from a macro lens. So we're in a situation now where energy prices as a whole are extremely elevated and, weighing on businesses, weighing on consumer activity, and it's become a serious problem. I think we're entering a period now where governments are starting to respond. And that's what we saw with the UK, right? We saw the UK essentially pledge uncapped liabilities to cap energy prices. That on tax cuts that followed that led to serious concerns about the fiscal situation in the UK. And we saw in the gilt market with the pound. Now you're starting to see similar programs being talked about and potentially rolled out in continental Europe. So from our perspective, we anticipate that energy prices will continue to be elevated. And now we anticipate the governments are going to react to that. And the important thing for us is going to be, okay, what does that mean for European fixed income and currency markets? And, how does the ECB respond?
You mentioned the gilt. I know that's something you guys have been watching pretty closely, the situation with the British pension plans, I believe. You briefly?
Yeah. So very simply, typically government paper, especially in a developed market, is high quality collateral that people can borrow against. So pension funds, in an effort to increase their yields to meet their liabilities, had levered up against their gilt holdings. Now, we saw massively outsized moves in the gilt market in response to policy proposals that we saw, which led to a decrease in the price of gilts, which led to margin calls. Now, when you get margin called, you don't sell what you want to sell, you sell what you have to sell. And the most liquid asset available happen to be gilts. So now you're in a situation where gilt prices are falling, so people have to sell gilts to meet obligations caused by gilt prices falling. And you can see how that leads to a vicious cycle very, very quickly. And the BOE had to step in and arrest that, or you would have had, you would have had a crisis.
It is symbolic, though, of a market and a economic environment that's getting increasingly volatile right now. To see situations like that, that's reminiscent of the global financial crisis that,
I think the way I would phrase it is it's difficult to know what is going to break in any environment.
Yeah.
What's less difficult to know is that when you're in an environment where things can break. And we kind of started here, and maybe we've come full circle with this. This is the type of environment where things can break. And that's an example potentially of that happening.
All right. Can I squeeze in one more? I know we're at the top of
absolutely.
the hour here. We get this question all the time, and I'm not surprised to see it here in front of me. We're getting close to another election cycle, although in this case, just a midterm one. But any thoughts or anything? I know you guys follow geopolitics pretty closely, which is a little different than outright politics, but anything from an investment standpoint?
I mean, we're not political forecasters. So at this point, we work with the data we have. It looks like the Republicans are going to take the House. It looks like the Democrats are probably going to hold the Senate. If that situation materializes, you've probably got a pretty ineffective Congress and government in the US that's not going to be able to pass a lot for the next 2 years. I think maybe the situation that would change the status quo the most would be if the Democrats manage to hold the Senate as well. We'll hold the Senate and hold the House, and we end up in a situation similar to the one we're in now, and they're able to get a bit more done. If that's the case, if they're able to, significantly expand fiscal deficits, you could potentially see a weaker dollar. But those are the types of conversations we're having. I don't know. I don't think I have any really strong views as it pertains to the market right now.
Yeah, and in many cases, what I would say is fundamentals, right? I mean, I know that's something you guys talk about a lot. How much of this would impact if you get a gridlocked Congress? How much is that really going to impact fundamentals?
Yep.
Yeah, exactly. All right. Well, thank you. Unfortunately, that is all we have time for today, Jake. It's been great having you here. If we didn't get to any of your questions, which we certainly didn't get to a few, we will be sure to follow up after today's event. A recording will be sent out shortly as well. We're also sending out a survey. It's in the chat right now. We'll send it out via email. We encourage you all to it's a brief survey, but send any feedback you can that helps us make these events each quarter as impactful as possible for all of you. Jake, thanks again for being here today.
Thanks for having me. I had a blast.
And to our listeners, thank you all for attending today's webinar.